After studying this module, you shall be able to first understand the concept of absorption costing and its limitations. Second, know the meaning and concept of marginal costing. Third, learn essential features of marginal costing. Fourth, evaluate different contribution and profit. Fifth, elaborate limitations of marginal costing and make comparison with variable and absorption costing. Now we start with understanding the concept of absorption costing. Absorption costing is a costing technique in which all manufacturing costs, whether fixed or variable, are considered while valuing inventories and determining cost of production. We consider all manufacturing costs as product cost and all other costs as period cost. Product costs are those costs which are incurred for the production of the products and can be identified with a product. For example, direct wages and direct materials, they vary with production. On the other hand, period costs are the costs which are the function of time and are usually fixed over a period of time. For example, annual insurance or rent. Absorption costing is also known as full costing, and this is one of the traditional methods for determining value of inventory and cost of production. As the name suggests, this is a technique in which we absorb the fixed manufacturing cost for the number of units produced. Absorption of fixed cost is done by an absorption rate, which is obtained by dividing the fixed cost by budgeted number of units. In this technique, there can be over and under absorption of fixed manufacturing cost, as absorption is done through a fixed per unit rate for a number of units produced. If the number of units produced is less than the budgeted units, we shall have under absorption of fixed manufacturing cost and vice versa. This over or under absorbed cost is adjusted while preparing the income statement. If it is over absorption, number of units produced more than budgeted, then we shall deduct the over absorbed amount from the cost of production and vice versa. Now we start discussing the advantages of absorption costing. The very first advantage is it is consistent with the matching concept, in which manufacturing cost of sales are matched with the sales revenue. This is why financial reporting standard requires absorption costing. The second advantage is it facilitates cost plus pricing strategy. In the long run, for survival and profitability, prices must cover fixed cost. The third advantage is it avoids separation of cost into fixed and variable, which cannot be easily and accurately done. The fourth advantage of absorption costing is the presentation of over and under absorption of factory overheads discloses inefficient or efficient utilization of production resources, which is not possible in variable costing. The fifth advantage of absorption costing is it provides awareness to the managers about the overheads for different departments through the allocation and apportionment of fixed manufacturing overheads. Now looking at the other side of the side, we shall now discuss the limitations of the absorption costing. The very first limitation of absorption costing is that absorption of manufacturing fixed overhead to product units by means of overhead absorption rate can sometimes be arbitrary. The second limitation is reported profits can be manipulated by adjusting inventory level in the short run. For example, reported profits can be boosted by inventory piling at the year end. The third limitation of the absorption costing is fixed manufacturing cost is sometimes seen as period cost, as it does not bring any future benefit, so it should not be considered as product cost. The last limitation of absorption costing is absorption of cost is not helpful to managers in taking decision making, as it does not always provide relevant information for decision making. Now we are going to understand the concept of marginal costing. Marginal costing is a costing technique in which only variable manufacturing costs are considered. While valuing inventories and determining cost of goods sold, we consider only variable manufacturing cost as product cost and all other costs as period cost. For the purpose of marginal costing, we can define product cost as direct material, direct labor and variable manufacturing expenses. We do not consider fixed manufacturing expenses while determining value of inventory or cost of production. Fixed manufacturing expenses, like any other period expenses, are written off from the profit and loss account in the period they are incurred. Marginal costing is also known as variable costing or direct costing. However, the use of the term variable costing is more appropriate. The term direct costing refers to those costs which can be identified and traced directly to the units of output, whether they are fixed or variable. For example, if there is production facility which produces only one kind of product, then all the costs incurred, whether fixed or variable, can be identified to that particular product. So the term variable costing is more suitable because it emphasizes on cost variability and requires that there should be a distinction between fixed and variable cost. The term marginal costing is also used interchangeably with the term variable costing. In fact, the term marginal cost means the increase in the total cost when one more unit of output is produced, which is different from variable cost in the sense that marginal costing also takes into account the increase in total cost, whether it is variable or fixed, while variable costing takes into account only the variable portion of total cost. But in short run, there is usually no difference between marginal cost and variable cost, as in short period fixed cost remains constant. Variable or marginal costing is not a distinct method of cost determination as job or process or any other method of costing. It is just a technique where cost of goods manufactured is composed of variable production cost. This technique can be used simultaneously with all methods of costing, including job and process costing. Now we start discussing the advantages of marginal costing. The very first advantage of marginal costing is that variable costing is easy to understand and use. It is applicable to standard costing and budgetary control. The second advantage is the valuation of closing stock on the basis of variability of cost, will not facilitate the transfer of part of fixed cost to next period. The third advantage is that there is no need of computation of unit fixed cost over and under absorption of fixed overhead because contribution margin over and above the fixed cost is the profit margins. The next advantage is in variable costing system, profit is calculated on the basis of sales volume rather than production units. The fifth advantage of marginal costing is that variable costing system assists management to take rational decisions, analyzing the effects of sales and production policy. The next advantage of marginal costing is that it concentrates the management on controlling the controllable cost, that is direct cost, and avoids the tension of allocating the fixed cost without taking any basis. The last advantage is that variable costing assists the management for taking rational decisions regarding profit planning and cost control. But as usual, along with advantages, we have certain disadvantages also. So now we discuss the disadvantage of marginal costing. The first is that there is difficulty in segregating overhead cost into fixed and variable cost, as sometimes segregation of fixed and variable cost may sometimes be erroneous. In comparison to absorption costing, this is an additional qualification needed. Second, it is not justifiable to exclude fixed manufacturing overhead from inventories, as the expenditure incurred is for the production of all units. It is necessary to absorb it for inventories as well. The third limitation is wide fluctuation in profits due to seasonal demand. As marginal costing rewards sales, profit for the periods in which sale volume are high can be misleading. Inventories from last period will be sold in the current high demand period, which do not account for fixed cost. The next limitation is variable costing is not useful for long-term planning and decision making. To survive in the market, it is equally important to recover fixed cost, as in the long term, fixed costs also become variable. Absorption costing technique fully acknowledges this fact. The next limitation is that variable costing is not acceptable for external reporting purpose, as reporting on variable costing technique would affect profits and shall not provide correct pictures to the external shareholders. In case of marginal costing, there can be no under and over absorption of fixed manufacturing overheads, as it is not absorbed on the basis of units produced. Then we have treatment of selling and administrative overheads, that whether fixed or variable is same as marginal costing technique. Both the techniques consider these overheads as period cost rather than product cost. Now we move further to discuss the essential features of marginal costing. The first feature of marginal costing is that it is a method of recording cost and reporting profits. The second is all operating costs are differentiated into fixed and variable cost. The third is that variable costs are charged to product and treated as a product cost. Fourth feature is that fixed costs which remain constant regardless of the volume of production do not find place in the product cost determination and inventory valuation. The next feature is that fixed costs treated as period cost and written off to the profit and loss account. The next feature is that prices of products are based on variable cost only. The last feature of marginal costing is that marginal contribution decides the profitability of the products. Now we should have a difference between Profit and contribution. We start with defining contribution margin. To understand the concept of contribution margin, it is very important to start with cost first. Every company has two types of cost, fixed and variable. Fixed costs remain the same regardless of how much a company produces. For example, rent. Variable costs on the other hand increase as output increases. For example, raw material. To determine a product's contribution margin, the variable cost of making it is subtracted from the revenue from selling it. The leftover portion is what that product contributes towards paying the fixed cost. Hence, it is named as contribution margin. Once the fixed costs are covered, the margin is what the product contributes toward profit. Profit shows how much of the revenue received from selling a product. It is left over after paying the cost for that product. Profit margin is the expression of a profit as a percentage of revenue. In general terms, the contribution margin tends to yield a higher percentage than the profit margin, since the contribution margin includes fewer costs. This can lead to an erroneous assumption that a company's profitability has escalated when the business has switched from the profit margin method to the contribution margin method, thereby shifting all fixed costs into a separate classification in the income statement. In fact, total company profits would be same no matter which method is used. Now we make a summary of our discussion we have discussed so far. In this module, we have studied about absorption and marginal costing technique. Absorption costing technique consider fixed manufacturing cost as production cost and absorb it for the calculation of cost of goods produced and inventories on the other hand. Marginal costing only takes into account variable cost while calculating cost of production and cost of inventories, and consider fixed manufacturing cost as period cost at par with administrative and selling cost.